All right, everyone, welcome to today's deep dive,
Huh?
where we're going to be taking a look at something pretty exciting, I think. We're always looking ahead, right? What's next? What's coming? And today we're strapping on those forecasting helmets, getting in our financial time machine, and heading straight to 2025. Specifically, we're going to be exploring what the experts think the S&P 500 might do a couple years down the road. It'll
Right.
be like a total moon landing, you know, like soaring past 6,600. Or are we looking at more of a market meteor shower situation?
That's the big question, isn't it? And to help us unravel this mystery, we've got a fantastic guide for this expedition, none other than FactSet, a company that practically wrote the book on financial data analysis. They've given us a ton of predictions to dig into, everything from earnings growth and profit margins, all the way down to what they think individual sectors might do.
Yeah, FactSet is definitely the gold standard when it comes to this stuff. So let's jump right into it. FactSet is predicting a 15% surge in earnings for the S&P 500 in 2025, which, wow, that's some serious growth, right? I mean, that's double digits, way above the average we've seen over the past decade. But here's where things get even more interesting. They're saying that a lot of this growth might actually come from companies outside the Magnificent Seven. You know, those big tech giants that are always in the headlines, Apple, Microsoft, Amazon, that group.
Right, sometimes they call them the M7 for short. So what FactSet's suggesting here is that we might see a broader market rally, not just a handful of superstars carrying the weight. Now, to really grasp why this 15% growth projection is so significant, we need to look at how FactSet actually arrives at these numbers. They use what they call a bottom-up approach, which basically means they analyze individual company earnings estimates and then add all those up to get the big picture. And it's important to note that this model depends on a couple of key things, like continued low inflation and people, consumers, continuing to spend money at a pretty steady pace. If those things don't hold true, the actual growth we see could be totally different.
Okay, so potentially widespread growth, but some big ifs in the mix. I'm following you. And on top of that, 15% earnings growth. FactSet's also predicting a solid 5.8% revenue growth for the S&P 500. Again, that's higher than the average we've seen over the past 10 years. But before we get too excited and start planning those early retirement parties, we need to take a closer look at profit margins. Because FactSet is expecting a pretty incredible 13% net profit margin for 2025, which is way higher than the 10-year average of 10.8%. And get this, it's a level we haven't seen since FactSet started tracking this metric back in 2008.
And this is where things get really interesting for investors, right? A higher profit margin means companies are keeping more of their earnings after paying their expenses. And that can translate to more dividends, stock buybacks, and ultimately the potential for bigger returns for investors.
All right, so let me recap for a second, make sure I'm getting this straight. We've got potentially strong earnings growth, and it might be driven by a wider range of companies than usual, not just the usual suspects. We've got healthy revenue projections and historically high profit margins. On the surface, that sounds like a pretty fantastic setup for the market, right? Like cue the confetti, maybe? But hold on, because now we've got to talk about the elephant in the room, those super juicy target price predictions. FactSet has set a 12-month target price for the S&P 500 at a mind-blowing 6,678.1. I mean, that's a serious number. So the question is it time to start planning that moon landing party? Well, not so fast. We got to remember that target prices are just that, targets. And while a number like 6,678.1 is definitely attention-grabbing, it's super important to understand how it's calculated. FactSet uses that same bottom-up approach here, adding up individual company target prices. But, and this is a big but, history shows us that analysts tend to be, well, a little bit optimistic. You're saying they've maybe overestimated things in the past.
Yeah, exactly. Over the last 20 years, analysts have overestimated the S&P 500's year-end value by an average of 6.9%. It's kind of like that friend who always says they'll be ready in 5 minutes, but always shows up 10 minutes late, you know?
Uh-huh. Oh, yeah, I definitely
Yeah.
know that friend. All right, so while a 6,678 S&P 500 in 2025 sounds amazing, history is telling us to maybe hold back on the champagne just a little bit.
Exactly. A little bit of healthy skepticism never hurts. Now, to help visualize all of this, we've got some interesting graphs we can look at. First up, we've got a chart that shows the projected path of the S&P 500 all the way through December 2025. It's a pretty steep climb up towards that 6,678 mark, but remember, we got to keep in mind
Yeah.
tendency for analysts to maybe get a little ahead of themselves. Let's bring up our second graph here. This one shows us the historical comparison between that estimated target price at the beginning of the year and the actual closing price at the end of the year. And you can see a pretty clear pattern there of overestimation.
Yeah, it's definitely noticeable. So Based on that historical trend, that tendency to overshoot a bit, where do you think the S&P 500 might actually land at the end of 2025?
Well, if we take that average overestimation of 6.9% and apply it to FactSet's current target, we get a more conservative year-end prediction of around 6,215. Still a really impressive game, for sure, but a good reminder to always keep those historical trends in mind.
Right. History can be a pretty valuable guide, can it? Okay, I'm starting to see why FactSet has such a stellar reputation in the financial world. You guys really know your stuff. But let's shift gears a bit now and zoom in on those sector-specific predictions, because I'm sure our listeners are dying to know where the potential opportunities might be hiding.
Oh, absolutely. That's where the real nitty-gritty is. Our third graph here highlights the projected price increases and decreases across all those different sectors.
All right, so let's start with the goodness. The sectors that are expected to really shine in 2025. And leading the pack, drumroll please, it's healthcare, with a projected price increase of almost 20%. I mean, wow, that's incredible. What's driving all that optimism?
Well, remember when we talked about that aging population trend? That's a huge factor here. As more and more people get older, the demand for healthcare services and products naturally goes up, right? Plus, we're constantly seeing new breakthroughs in medical technology and drug development, which creates tons of new opportunities for companies in this sector.
Right, new treatments, new tech, all that exciting stuff. Definitely adds to the buzz around healthcare. What about the materials sector? They're looking pretty good too, with a projected price increase of 16.8%.
Yeah, the story behind materials is really tied to overall global economic activity. If the world economy keeps growing, as a lot of economists are predicting, we can expect to see higher demand for materials, used in all sorts of things, from construction and manufacturing to those big infrastructure projects everyone's always talking about.
So if you're feeling bullish on global growth, materials could be a smart place to put your money. Makes sense to me. Now, energy also has a projected price increase of 16.7%. But you mentioned earlier that energy is actually expected to see an earnings decrease, even with all that growth. Can you unpack that a little bit more?
Yeah, sure. The energy sector is going through a pretty major transition right now as the world starts to shift away from those traditional fossil fuels and moves towards renewable energy sources. It creates this kind of complex situation where revenue might actually grow because global energy demand is still increasing, but profits might get squeezed because companies are facing all these challenges, adapting to this whole new landscape.
It sounds like kind of a tricky balancing act for those energy companies. On one hand, they've got the potential for growth driven by global demand. But on the other hand, they've got this pressure to transition to cleaner energy sources,
Hmm.
all while trying to keep those profits rolling in. It's a fascinating challenge.
Exactly. It's a good reminder that even within those sectors that are projected to grow, there are always nuances, potential challenges to consider.
Yeah, it's never a simple story, is it? Okay, so we've got healthcare, materials, and energy as our potential high-growth sectors, each with their own unique twists and turns. But what about the flip side? Are there any sectors that are predicted to maybe struggle a bit in 2025?
Well, there's one sector that stands out as a potential underperformer, and that's consumer discretionary. It's actually the only sector that's predicted to see a price decrease, coming in at negative 3.3%.
Wow, a negative projection. That's definitely something investors want to pay close attention to. What's driving that downward trend?
So, consumer discretionary is really sensitive to what's happening in the economy overall. This sector covers all those goods and services that are considered non-essential, things like restaurants, travel, luxury items. When the economy weakens or if people are feeling uncertain about their finances, they tend to cut back on those discretionary expenses first.
So it's not necessarily a sign that a recession's right around the corner, but maybe more of a reflection of consumers being a little bit cautious with things like inflation and rising interest rates still on their minds.
Yeah, that's a really good way to put it. It's about understanding how consumers are feeling and how those big economic factors can influence their spending habits.
Makes sense. All right, so we've got a mixed bag of sector-specific outlooks here. Some potential high flyers like healthcare and materials, bit of a complex situation over in energy, and some potential headwinds for consumer discretionary. Definitely a lot for investors to think about. But before we jump to any conclusions, I think we need to take one more look back at history, see what lessons we can learn from those past predictions, and how they might inform our understanding of what could happen in 2025. All right, so we're back for the final part of our deep dive into the S&P 500 in 2025. We've explored those bullish projections from FactSet, unpacked those sector-specific outlooks, and now I think it's time to bring in the wisdom of the past. Those historical trends that can give us some much-needed perspective.
Looking at historical trends is like, it gives us this really cool lens through which we can view all these future predictions. Like, we've seen how analysts have this tendency to overestimate the S&P 500's year-end value. That average overestimation of 6.9% over the past 2 decades is pretty hard to ignore.
Yeah, it definitely makes you think twice, right? But we also saw that interesting little twist where analysts actually underestimated the S&P 500's closing price in 4 of the past 5 years. So does that mean things might be changing? Like maybe those old patterns aren't as reliable as they used to be?
Hmm. It's definitely possible. It could be a sign that the things that influence market performance are evolving and that we can't just rely on the past to predict the future. But I think we also need a healthy dose of skepticism here. Gotta remember that past performance never guarantees future results. It's like trying to predict the weather. You can look at all the historical patterns you want, but there are always those unexpected storms that can pop up out of nowhere.
Yeah, that's a great analogy. So it's all about finding that balance, right?
Yeah.
Acknowledging those historical trends, but also being open to the possibility that new patterns might be emerging. Okay, so for our listeners who are eager to apply all this to their own investment strategies, what are some key takeaways they should keep in mind as they navigate these potentially exciting but also potentially turbulent market waters?
All right, well, first and foremost, don't get swept away by those big, bold predictions, even with all those strong earnings growth projections and those tempting target prices. A little bit of caution is always a good thing.
Right, don't let those exciting numbers overshadow the importance of due diligence. Don't just jump in head first. Take the time to understand what's actually driving those projections.
Another crucial takeaway is the power of diversification. Remember, don't put all your eggs in one basket. Spreading your investments across different sectors can really help mitigate risk and potentially boost your returns, especially considering those sector-specific outlooks we discussed. Some sectors are looking really strong, while others might face some challenges. A diversified portfolio can help you navigate those uncertainties.
And let's not forget about staying informed, right? Markets are constantly changing. New information comes out every single day. Staying up to date on market trends, economic indicators, company news, it all helps you make more informed investment decisions.
Couldn't agree more. Knowledge is your most powerful tool when it comes to investing.
Well said. And with that, we've reached the end of our deep dive into the S&P 500 in 2025. We've covered a ton of ground today, from those optimistic projections to historical trends and sector-specific outlooks. But remember, this is just the beginning of the conversation. We encourage you to keep exploring these topics, dig deeper into those sectors that piqued your interest, and most importantly, craft an investment strategy that aligns with your goals and your risk tolerance.
Absolutely. And hey, don't forget to share your thoughts and insights with us on social media. We love hearing from our listeners. Until next time, happy investing.